Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look through the charts, pay attention to these markets, make sense of the themes and patterns using the power of technical analysis of charts, of data visualization, investor behavior, breadth, sentiment, investor psychology, all the good stuff to try to make sense of things. As I mentioned in the introduction, there's been a lot of themes. This is sort of an interesting day where you have technology down 1.8%, communication services down 1%. There's some names, particular Facebook and others with some news driving them downwards, but certainly weighing heavy with the Nasdaq 100 down over 2% today. That was really, I think, the story moving downwards. But you have energy, you have industrials, materials, all finishing more positive. So overall, we're in this clearly in an uptrend. The path of least resistance, I would argue, remains higher until proven otherwise. The question, as always, is what's actually driving the prices higher? What markets, what stocks, what names, what groups, what themes, and we'll try to hit on as much of that as we can with our time together today. We have some great guests. I'm excited to talk to Chris Vermeulen on the show today. From the technical traders. Tomorrow, Sentiment Day. We have Mark Young from Wall Street Sentiment coming back on the show. Always good to hear his take on the sentiment readings every Thursday. Next week on Tuesday the 15th, we have Jay Soloff joining the show for the first time. Jay's from Investors Alley in Arizona. Also, as a reminder, we're coming up very soon to our year-end programming called Reflections 2020. The last 2 weeks of the year on StockCharts TV are going to look a little different, but in a really cool way as we sort of set the stage for next year, think about how we wrap up this year and make sense of it. We have 3 sets of programs. One is 10 charts in 10 days. We have 10 different strategists all sort of giving you their top chart of the year and what it meant to them. Should be a really cool series of quick videos from some top experts. We have a second series on sector rotation, which Julius DeKempener is going to run. We have some analysts digging deep into particular sectors. And then the third part I'll be leading, talking about sort of year-end reviews, how you evaluate your performance, think about the next year. I had a great conversation with Keith Fitzgerald here in town in the Seattle area yesterday about sort of how to approach that process. And I just recorded a video today looking at 10 questions you should ask yourself at year end. So it's going to be a lot of fun and hopefully causes you to think and reflect on your own performance, set the stage for a good 2021. I think we all need one of those. Let's get to our market recaps. I mentioned stocks overall weaker and the average stock finishing weaker than yesterday. It's coming off of a pretty accelerated level yesterday with the S&P closing above 3,700. So if you were looking for follow through, looking for upside validation, you didn't get that today. You got more things that looked a little more like a bearish engulfing pattern. I didn't check the S&P right at the close. So it looks, again, it depends on how you want to call this, but arguably a good bearish engulfing pattern, which is an up day yesterday, a higher close, and then a higher open today. And then we close below the previous day's open. So on a candle chart, it's a big up candle followed by a big down candle in the second day's range, eclipses the first day's range. That's short-term negative. It tells you the next day or two, next couple bars should be more, should be net negative. Overall, though, I mean, the market still, again, made a new intraday high today. So don't get me wrong. This is coming off of a very high level. Trends overall are still in place. You have stocks that are rallying just fine today. So, overall, I think this is continuing to be about rotation. It's continuing to be about the seasonally strongest part of the year and how we deal with the fact that the market's just gone so far to get to this point. Let's continue on with some of the other themes. Mid caps and small caps both down as well, but the S&P led the way down. What really led it, looking at the major indexes, the Nasdaq 100 down over 2%, the VIX back up around 2230. 10-year yields higher, and we're going to look at a chart of the 10-year yield here in a minute. And if the 10-year yield was a stock, it wouldn't be a bad chart. It's actually, a nice pattern of higher highs and higher lows. And again, I have people saying, well, can interest rates get above, really get above 1? And I'll say the same thing that when people ask me, can it really get below 1 on the way down when it got a lot lower than that? Of course it can. Hypothetically, it can go a lot of places. I'm interested with following the trends, and the trends in interest rates have been positive. Looking at the TNX, the dollar index essentially flat. Metals down again. So gold and silver. We had gold running up pretty good in the last couple of days, but certainly giving a lot of it back today. Commodities holding steady overall. Cryptocurrencies essentially sort of flat to up, with Bitcoin up just about 0.25%. I mentioned interest rates. I just wanted to show the chart again. If a lot of times you cover up the ticker and say, if this is a chart, what would you think about it? How would you interpret it? Here's the TNX, which is the 10-year yield index. So basically take this, divide it by 10, and that's essentially the yield on the 10-year. You can see it's at about 94 basis points today. So overall, you have this nice sort of cup and handle pattern, essentially, in interest rates. With the June peak retested here in early November, now retesting that, sort of the rim of the cup here at the beginning of December. And this is a classic Bill O'Neill pattern where you have a big rounding bottom, you have a shallower sort of pullback coming off the resistance. And, honestly, I think a close above 1% really opens the potential to go much further than that. And overall, I see that certainly happening. That certainly seems to be the trend until proven otherwise. Higher highs and higher lows. You flip that over and you have the chart of the TLT or the AG, which is in more of a downtrend. TLT probably the most exaggerated of those here in the middle, just sort of in a classic downtrend below a downward sloping 50-day moving average, similar to the US dollar. I'd rather wait until you get some sort of indication of a reversal before you get excited about a chart like that. We're going to dig into breadth. We have a segment banking on breadth after our guest today. We'll save some of those charts for a little later in the show. So let's continue on with sectors. Energy was the biggest gainer. Not much, though, less than 1/3%. These are sort of settling in as we process the closing trades and everything. But the XLE was up about 0.3%. Industrials and materials were the only sectors that were positive. Everything else down. And it was really tech, communication services, as the weight on the S&P pulling things lower to push it down to a lower low. Interesting to see the two consumer sectors right in the middle. We're going to talk a little later about tobacco stocks. Actually, an interesting pattern. If you look at Philip Morris, you look at Altria, Philip PM in particular comes to mind as just a really interesting breakout pattern. The question with stocks like that is, what's the staying power? How much of upside do you see overall? Looking at some of the themes, can't help but notice things that are and again, these are the biggest gainers in their scooter ranking, the biggest losers in their scooter ranking today. So it's looking day to day, how much have changed based on this trend following model that we have. This is looking at the entire large cap space, seeing what's working and what isn't. And in this case, seeing what's changing. You can see a lot of airlines here that in the biggest losers today. Southwest is the one that's lost the most. And again, it's coming off of a pretty solid level. So you saw what's called a shooting star candle just a couple days ago, and you're getting some follow through now to the downside. But overall, again, just beginning to undercut the most recent swing low. I think there's a little more that needs to happen for you to feel that this is a broken chart. It's sort of coming off of a nice after a nice run higher. But interesting to see with airlines. This is a group that a lot of people had forgotten about or sort of written off. All of a sudden, starting to emerge and really doing pretty well. And we'll see if that weakness continues. State Street is an interesting one. This is another bearish engulfing pattern, pretty exaggerated with the update yesterday, the gap or the open higher, but then it closed much lower. That short-term week, it was down 4% today. Financial stocks in general have been looking pretty good and started to really, improve, coming out of patterns that had been less attractive, but stocks like that with a bearish engulfing pattern coming off of a nice short-term high is something to be a little wary of. Boeing as well. We just talked about Boeing. I think it was one of our 3 and 3 charts yesterday, down 15 points in the scooter rankings today, just down under 2%. So not a huge down day, but it's worth noting some of those that have come off home builders as well with DHI continuing to struggle. What started to do well? Lowe's actually gapping higher. This is Nielsen NLSN, which was the biggest gainer. Charts like this are really pretty impressive, right? This is a pattern of higher highs and higher lows. It's eclipsed its June high, continuing to bump up. If you're long a name like this, I think it's a really natural opportunity to keep bumping stops up as we track the price moving higher. Overall, in pretty good shape. The relative strength improving as well over the last 8 weeks or so, which is pretty impressive. I think the concern with something like this is when a stock goes vertical, what do you do with it? And I'm often asked something like that. So I would say, number one, make sure that you're bumping up your stop effectively. I think a lot of people oversimplify and they think, all right, the 50-day is my stop. And that's good as long as the stock is really close to its 50-day moving average, right? And so if your stop's no longer relevant, right? If the price is so far away that you'd have to give back 30% to get back down to your stop, then you probably want to keep bumping it up. So trailing stops, percent stops, something using the ATR, the average true range, or something that more recognizes the ranges that we're dealing with would be helpful. Stock's just getting to the overbought region, so it's something to watch. That's what would put it on my list to see what may happen next. We need to take a quick commercial break. We're going to be back with my guest, Chris Vermeulen. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us on the show every weekday after the close as we look at the technical themes of the day using StockCharts.com. As a reminder, we have another mailbag segment at the end of this week on Friday's show. A couple ways to get your questions to us. Number one, via email, thefinalbar@StockCharts.com. Number two, on Twitter, just tag us in a comment at FinalBarSCTV. Finally, on our YouTube channel, just put a comment below the video you're watching. We'll capture all of those and hope to answer one of your questions in our next mailbag segment. We've had questions all over the board and all across the board, and nothing is out of bounds. I want to welcome on my guest, Chris Vermeulen. Chris is the Chief Market Strategist at the Technical Traders based in Ontario. Chris, welcome to the show.
Hey, thanks for having me, David.
So I appreciate you sending some charts ahead of time. We're starting with a theme that I think a lot of people have been, starting to think about. We small caps, I think a lot of people had sort of written off, and all of a sudden they've emerged, with a fury here at the in the second half of the year. Talk us through small caps and what you're seeing.
Sure. Yeah. Well, they've been out of favor, obviously, for a couple of years, and they went through their own bear market. They made their series of lower highs, lower lows, and they have come back from the dead. And I think they caught a lot of people by surprise, breaking out some new highs here. And, it's pretty interesting because we went from a tech-heavy market only a few months ago to now we are seeing money piling in, renewed excitement from investors piling into small caps, growth stocks. And we're seeing a lot of sectors in smaller industries really just start to take off and explode to the upside. Transportation index is supporting this as well. So we're definitely seeing investors and the whole market really shift gears into what feels like a brand new full-fledged bull market. Although the fundamentals and what's going on in the economy, I don't feel like we should be in a bull market. The thing is, the charts are how we make money. And if price doesn't go in our favor, we don't make money. So we have to follow price. So no matter what we think or feel, we're following the charts here. And the charts are pointing to higher prices, as you stated earlier. We're more or less in a raging bull market. And the key here is to find where the leaders are and be involved in these leading sectors and stocks because they're going to outperform dramatically. And so the Russell 2000 is just that kind of line in the sand saying, hey, let's get back to focusing on some individual stocks, some very volatile, fast-moving sectors because there could be a lot of legs ahead of this market still.
I feel like the why tends to become a lot clearer in the rearview mirror. It seems like down the road. So I love your comments to stick with the trend and stay with what's working. You mentioned individual stocks, and your second chart is focusing on REMX. Talk us through this one.
Sure. So I use a strategy that I call a band trading strategy, which is best asset now. And more or less, I'm looking for the leading sectors, and I use a bunch of different analysis that takes the chart price action. It'll automatically calculate if it's a bullish or bearish pattern. It's telling us the overall trend. It's telling us if this market the sentiment is risk on or not. Is money flowing into the stock market, going into the risk on assets and out of the defensive like gold and utilities and bonds, or is it going into stocks? So when all these things line up, I can then sort them just like we do with the scooter list of finding the strongest stocks and sectors that you were looking at a minute ago. This is kind of the similar type of thing. And so this REMX is one that's kind of popping on the charts, and it's giving us some really good signals. Now, it gave us a beautiful band signal earlier in November, and it's just taken the lead. And we're seeing this across the board with a lot of these sectors, uranium stocks as well, clean energy, solar, all these. And when you look at this chart, I mean, it's had a very big run. It looks like it's got room for more upside just based on some Fibonacci extension targets. And it is leading the market. And it's known that, you know, a sector that's been leading the market for 3, 6, 12 months is more likely to continue to outperform the rest of the market than it is to underperform. And so that's why obviously a lot of investors focus on leading sectors. And this is one that's really just started actually what looks to be a new kind of bull market longer term. And I like this sector just because it's explosive. This is just an example of the type of moves we see. The SP 500 for the same time frame, it only moved 5% to the upside. And this has moved 24, you know, almost probably 30% actually when you look at the most recent bar. So it's nice to get into these sectors or these smaller industry ETFs because they move a lot like stocks.
Your third chart here is showing REMX and really focusing on the signal that you saw there in November.
Right. So this is the type of signal that more or less the way I focus is there's a time to be in stocks and a time not to be in stocks. That's the way I see it. I track the SP 500, the NASDAQ, and sometimes I'll be out for a month or a few weeks, and other times it'll give me a broad market signal, and that's when I get into the market. So for example, through September and October, out of the market, and then we started to see all the sentiment indicators, all the intermarket analysis really indicating, hey, money's starting to move back in, momentum is shifting to the upside, big money is rotating into equities. And so once we get that signal saying, hey, we need to get long the stock market, that's when I jump into looking for the top performing sectors. And this is one that popped out and said, hey, it's outperforming a lot of other sectors. On this day, it's beating the QQQ, it's beating a lot of other sectors. This is the one to jump into, and they have all the characteristics that should point to much higher prices. And so there's a long list of these where they just pop and they run, and you can see the upside. Yeah, it's about a 36% move, and this is the type of play that I like to focus on. You get the benefit, the price action almost of an individual stock, but you're still playing an ETF. It's just because it's a smaller pocket or basket of stocks, and you're not quite directly affected with individual news of a company. So you get like a nice hybrid play. It moves like a stock, but you get the kind of stability of an ETF. And that's what I love about this is finding the hot sectors, breaking the sector down into the industries to find the hottest little industries within those sectors. And then you can take it one step further and find the individual stocks within that sector, which would make these moves look like chump change because they move even more. So it's really exciting when you get into obviously following the leaders. You can get down to as nitty gritty as you want, the smallest play to get into.
No, we only have about 30 seconds left, Chris, but I'd love to ask you on something like this with REMX, something that's had a run 30, 35%. I mean, it obviously feels, hopefully you own it, you feel good about it, but probably at this point you start to look and think, all right, that was a pretty huge run. At some point I want to start taking profits or bumping up my risk. How do you coach people just very quickly to deal with a chart like this? How do you lock in the gains, but not miss out on potential further upside? What's the trick there?
Yeah, so the type of index signals that I have, I base everything off an index signal. The average trade lasts around 30 days. Long story short is I look to take partial profits around 7%, 15%, 25%, and then I leave a 15% trailing stop until it gives me some big blow off bar or a candle that I go, whoa, this looks like it's exhaustion. And then I'll tighten that final trailing stop up to 5 or 10%, choke it out in case it does reverse very quickly. So it's important to scale out, but you got to leave the runners in because I see these all the time go 20%, 50%. I mean, you look at the solar, I mean, those sectors are up 270% since the March lows. They're insane. So there's
all
lots
small
of potential.
gains begin or all large gains begin as small gains, right? So sticking with the things that are working can be pretty helpful. Chris, this was fantastic. I really appreciate you talking through this example, giving us a sense of your approach. Thanks for coming on the show. Hope you stay safe, and we'll talk to you again soon. All right.
Yeah. Thanks, David. Take care. Appreciate it.
That's Chris Vermeulen, the chief market strategist at the Technical Traders, joining us from Ontario. I love that idea, and there's a lot of just great nuggets in his comments there. But I think that's something a lot of people talk about, a good problem to have, owning something that's run. We were looking at the chart of Nielsen earlier. That's just had this brilliant run. All of a sudden, it's up another 9%. And the question always is, what do you do then when something's gone up so much? You start to get worried about what to do. And I think that idea of scaling out of positions, of thinking of trailing stops and objectives and how you relate those is a really important part. I think people spend way too much time thinking about their entry strategy, not enough time thinking about their exit strategy. Great comments from Chris Vermeulen there. We need to continue on the show here, move on to banking on breadth. This is a regular effort to review the breadth indicators that we're seeing and pay attention to the key signals that we should be looking at. To summarize what we're going to see, the breadth overall remains overwhelmingly positive, is how I would describe it. You think about, my macro discipline has a price component, which is primary. That's the main thing. The number one important question to answer is, what is the price doing? What's the trend? The second way is breadth. How do you qualify that trend and confirm or deny what you're seeing with price? And then third is sentiment, which for me, a little more anecdotal. It's telling you the qualities of the price move and who's doing the buying and selling. But, it starts with price and then goes to breadth. So if you look at the cumulative advanced decline lines on the S&P 500, on mid caps, on small caps, on the NYSE, these are all very subjectively color-coded green. I sort of do this once a week, check these out and decide what the overall trend is. And these have all broken to new swing highs. They've all made new highs for the year. They all continue to make higher highs and higher lows. Especially, you should notice the small cap breadth, which is just really accelerated to the upside. So across the board, it's telling you there's accumulation happening. Overall, the trend is strong. And until that changes, the path of least resistance is higher. Going into the close, I was wondering what this advanced or decliners look would tell us. This is just looking at the daily advanced decline read, and it's just a shorter term gauge of how many stocks are up or down. You see it was split about 50-50 today. So even though it was a down day, you have a bearish engulfing pattern. You're showing some potential weakness, and names like Facebook and others certainly down in a more meaningful way. Half the stocks were higher today, so still it was a mixed bag. Things like energy and others were able to move higher during this period. This is volume on the advancers versus decliners. Overall, has been fairly positive if I look over the period of time. I've had some questions about volume, which I'll try to get to if I can get to a chart here a little later. One of the more, if there is a concerning chart, warning flags that pop up, one of them is this chart, which is looking at the percent of stocks above their 200-day. It's around 91%. It was at 92% yesterday or the day before. And overall, it's very elevated. You have to look back years to find the times, a limited number of times in the last 20 years when there have been, 92% of the S&P above their 200-day. And if I could summarize what happened, what tends to happen after that, the year after, the market tends to be higher because this only usually happens in bull market phases and cyclical bull markets. You don't get that sort of signal in a down tape and in a downtrend because just stocks are not appreciating that much. So I think part of that is it's sort of a self-selection. You're selecting, or a selection bias, maybe I'd call it. You're sort of looking only at examples during both phases. So clearly that's been positive. But if you look at the short term, it usually means the market's a little bit extended. And even though the long-term trend can be positive, more often than not, you'll get a little bit of a pullback. I think that might be what we're setting up for. But again, until the price turns, I have to follow the price higher. This is looking at the stocks above the 200-day on the S&P and also the New York Stock Exchange, a little broader list. There have been times when this has been different. So if you look back here a couple months, you saw only about, it was maybe 60% of the S&P above their 200. It was only about 50% of the New York Stock Exchange. So there were less of the smaller names that were working. That's now been overcompensated for, and it's about the same reading looking at the S&P and the much broader list of New York stocks. New highs to new lows is an interesting one. This is not quite updated for today just yet, but overall, you're seeing on up days about 50 names. That's about 10% of the S&P making a new 52-week high. That's actually pretty consistent sort of post-March low during nice uptrends like in July and August and October. That's about what you saw on average. What I would point out, though, is that's very different from what you saw back here in December, January, February, sort of the new year 2020. You had many more stocks making new 52-week highs consistently. We're not seeing that. So again, it's still not a broad everything going up, at least going to new highs. Still, stocks are still, in a lot of ways, and I think the reason for that, it's things like energy and financials that are still nowhere near their all-time highs or their highs even from earlier in the year. Bullish percent is an interesting one, and I wanted to just point out that this is looking at what percent of S&P stocks using point and figure charts are in buy signals versus sell signals. It's about 76, 77% of the S&P as of yesterday in a buy signal most recently. The way you use this chart, we remain above 70. Thumbs up, the trend overall is broad and positive. We break below 70, you can see this lines up with some of the more corrective periods as we adjust down from a nice run. You have a big run higher, this breaks down, and it could be just a short-term correction. It could be a much longer correction like you see here in February to March. You had a same sort of reversion back below that 70% line. So that's one thing I would look at. We would need to just finish here just for time's sake, but I mentioned volume earlier. I get questions about the lack of volume, especially recently, and I hear you, and you're right. If you look at the price versus volume, you see the price gaining on lighter volume. I'm kind of numb to that, though, because I can point out plenty of examples just in the last year where volume has been declining while the price appreciates, and that hasn't been a problem. For me, volume has become less and less of an indicator for me. I used to study tons of indicators, breadth indicators based on volume, and overall it's become less and less important to me, mainly because I've seen examples of that where the market rallies on lighter volume and doesn't seem to care about it, doesn't seem to stop the uptrend. Having said that, of course, this is when the market will tank because we're rallying on lighter volume. I will eat crow and admit it the moment I see it happening. We need to wrap the show, go to the 3 and 3 charts, 3 minutes. Here we go. Chart number one is the S&P with a bullish percent index. We just finished here a few moments ago. And just to reiterate, this is the kind of chart that I like to look at now. I often use the comparison or the analogy of flying in an airplane. When you don't wait until the engine cuts out to figure out where you're going to land the plane and look for an appropriate airport or a landing strip or something. You do it when everything's fine, right? When you're flying straight and level, a couple thousand feet, no problems. That's when you think of your exit strategy, and that's why I'm looking at this kind of chart now, as the market is making a new 52-week intraday high again today, above 3,700. I'm looking for what signals I would want to see that would be my bull market top playbook. This would be one of them, which is the bullish percent index getting below 70%. Until that happens, I don't think you have a ton to worry about in terms of potential downside. Chart number two is the 10-year yield. As I mentioned earlier, if this was a stock, I would say it's a classic William O'Neill cup and handle setup that we're seeing. You have to break above 1% to sort of complete that and make it a complete cup and illustrate the breakout, but essentially measures much higher. It suggests 10-year yields can go much higher. It suggests stronger interest rates. And I think the RSI range has been in the, sort of bullish for rates sort of range, above 50% or above 50 on the RSI for quite a while. So overall, I think it's suggesting weaker bond prices, higher yields from here. Finally, I mentioned tobacco stocks had a nice run, and PM was up over 2% today, which is a nice sort of bounce in a sector that I think a lot of people don't like for legitimate reasons. The prices have not demonstrated that you need to be in PM up or in consumer staples up until now, but that's changed a bit. We have a nice higher low above its 50-day moving average, a nice bounce off moving average support, a break above a short-term trend line from the September to November highs. We're now, and again, all of that is positive, but the problem I have now is we're overbought right as we approach this resistance area. And if you look at the January to February highs, we're right in that sweet spot. I think a close above 86, a nice follow through to the upside would maybe invalidate that area of concern. But I think about this from a risk reward perspective. I'm seeing limited reward because we're up facing significant overhead resistance, but plenty of risk, right, with downside to some of the previous support levels. That's our show for today. Thank you so much for watching every weekday after the close as we look at the markets together through technical analysis. Special thank you to Chris Vermeulen from the Technical Traders joining us from Ontario today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.